Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
It's a new trading day. Welcome to Modern Investing Techniques, episode 44, for May 16th, 2026. I'm Patrick, coming to you from Vancouver. Let's look at what the markets are telling us today and find some opportunities. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Canadian investors holding U.S. financials should review exposure to private credit names like Apollo after the stock hit 15 times earnings amid sticky insurance float that generated $3.4 billion in spread-related earnings last year. Markets closed lower today, with the S&P 500 finishing at 7,408, down 1.2%. The NASDAQ Composite settled at 26,225, down 1.5%. The TSX Composite closed at 33,833, down 1.3%. Bitcoin fell to $78,000, with $550 million in long liquidations triggered by rate hike fears. Brokerage forecasts for 2026 rate cuts range from 0 at some firms to 75 basis points at Citigroup, leaving investors watching energy names and Apollo for Monday follow-through. With markets pricing higher for longer rates, let's turn that divergence into a concrete options income strategy. Brokerage divergence on the 2026 Fed path creates a clear option strategy window for income-focused accounts. When forecasts range from 0 cuts at BofA and JP Morgan to 3 cuts at Citigroup, the market is pricing in higher for longer terminal rates than many expect. This setup favors selling premium on rate-sensitive names rather than directional bets. Use your broker's options chain to identify names with elevated implied volatility but stable fundamentals. Then sell 30 to 45-day calls or puts against core holdings. The approach has historically delivered best results in sideways to higher rate environments, where realized volatility stays below implied levels. Risk comes from a surprise policy pivot that compresses volatility faster than expected. Platforms such as Interactive Brokers or Questrade let you screen for the highest premium names while keeping position size under 5% of the account. That same rate environment also frames our main simulated position this week. This is a simulated trade for educational purposes only, and uses no real money. Today's practice investment of the day is Apollo Global Management, ticker APO, on the NYSE. The strategy centers on value assessment of an insurance float model, trading at 15 times adjusted net income, with 15% projected organic growth. The catalyst is record $3.4 billion in spread-related earnings from Athene's sticky annuity float, plus defensive positioning away from SaaS lending. On the technical side, the price sits near $130, below the 50-day moving average on the daily chart, with RSI 14 around 42 and volume running 15% below the 20-day average. Risk assessment flags Epstein-related LP relationship concerns that could pressure new fundraising over 12 to 18 months, so we set an 8% stop below entry. The target calls for 4 to 7% upside over the week if multiple compression reverses on earnings clarity. We rate this setup medium because the fundamental story shows strong tangible asset backing, yet relies on a single factor of float stability without volume confirmation. This trade demonstrates how to quantify the insurance float advantage versus traditional episodic fundraising models, and how to size a position when headline risk exists but core earnings remain intact. Before we check how last week's trade performed, here is the rule we are carrying forward. Last week's simulated hold was ACM after an infrastructure consulting contract win that offered multi-year revenue visibility. We entered at $80.09 on Monday's open and exited at $71 on Friday's close. The position lost 11.35%, or $113.50 on a $1,000 simulated stake. That compared to the NASDAQ falling roughly 1.5% over the same window, producing negative 9.85% alpha. The infrastructure contract catalyst proved insufficient once broader market rotation favored pure AI plays instead. The lesson is clear. Always require volume confirmation above the 20-day average before entering momentum trades on earnings beats. While we refine entry discipline, Cathie Wood's ARK model offers a different lesson on volatility. Imagine you bought ARKK last week after a 5% bounce on AI news rotation. Your fill came at the ask because the ETF's average daily volume had thinned to roughly 4 million shares, widening the spread from 3 cents to 12 cents in the first hour. That spread cost you an immediate 0.4% drag before any price movement. Cathie Wood's ARK Invest model bets on convergence across 5 platforms including AI, robotics, genomics, energy storage, and blockchain. The 2021 150% plus gain was followed by a 70% drawdown as mean reversion hit concentrated bets. The key mechanic most retail investors miss is that thematic ETFs rebalance daily based on price momentum, automatically selling winners and buying laggards, which amplifies volatility. Professionals always check the holdings overlap with broad indexes before adding because ARK's top 10 often exceed 50% weight. The biggest mistake with innovation-themed products is treating them as diversified growth exposure. Instead, always size them as satellite positions no larger than 5 to 8% of total equity, and rebalance annually against a broad benchmark. Now let's scan the rest of today's headlines in quick hits. Bitcoin dropped below $80,000 as rate hike fears triggered a $550 million long flush. Crypto exposure in Canadian registered accounts now faces higher volatility than equities, so trim any Bitcoin ETF holdings above 5% of your TFSA if price closes below $76,000 this week. Thorchain confirmed a $10 million exploit across 4 chains and opened a portal for users to revoke approvals. This highlights ongoing smart contract risk in DeFi protocols, so move any Thorchain-related tokens to cold storage and avoid new deposits until the recovery process completes. Pet Value shows scale advantages, yet the stock has been range-bound despite efficiency gains because margin pressure from higher input costs appears to be capping upside. Add PET to the watch list, but wait for a break above the 200-day moving average before considering any new TFSA position. Qatar needs $4 billion worth of Patriot missiles to replenish air defense inventory after the Iran conflict paused, creating potential multi-year revenue visibility for U.S. defense contractors. Add a small satellite position in a broad defense ETF, such as ITA, on any dip below the 50-day moving average. For listeners who want real-time data on names like APO, here are 2 tools worth testing. Benzinga Pro lets users filter AI-related names trading below $10 by revenue growth, short interest, and options flow in real time. The edge comes from seeing unusual options activity and institutional block trades before the broader market reacts, and intermediate Canadian investors running TFSA accounts can use the free tier for basic scans before upgrading for live audio. Cash App's built-in stock and ETF buying lets users purchase fractional shares of cloud and AI names with no commission and instant settlement. The platform's recurring investment feature automates dollar-cost averaging into volatile growth names without timing pressure, and suits younger investors building positions under $5,000 who want mobile-first execution. Finally, put today's APO discussion into action with this week's listener challenge. Open your brokerage platform, pull up APO's options chain for the nearest monthly expiration, and calculate the premium you would collect by selling a 5% out-of-the-money call against 100 shares. Note the annualized yield and decide whether that income offsets the headline risk discussed today. Before we wrap, keep an eye on energy names tied to Iran developments for any Monday open follow-through. That's it for today's Modern Investing Techniques. The resources page has links to everything we discussed. Subscribe and share with someone who wants to go beyond index funds. See you tomorrow. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.